presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for March the 21st. 2023. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. Well, tomorrow is the big day, so we'll talk about the Fed. What is the Fed going to do or not going to do? That is the big question everybody's asking. We'll take a look at the market, the economy, and the technicals. We've got some rather interesting technical charts this week where we had some gap ups in the market. What are those gaps? Are the breakaway gaps? Are the exhaustion gaps? What are the Fibonacci targets on the NASDAQ? We'll talk about all of that today. So let's start with the Fed. Tomorrow is the big Fed meeting. Expectation is 84% probability that the Fed is going to raise interest rates by 25 basis points. That's what there is a lagged effect on how long it takes for the Fed to raise rates to when it does impact the economy. Anywhere they're saying that we still have quite a bit of impact to come until the middle of this year for to catch up with all the rate increases that the Fed has already done. So now the Fed has got to thread the needle. Are they going to go and raise rates so much that they're going to slow down the economy? That was the problem previously. When are they going to cause a recession? Now, when are they going to break the banking system? A lot of the banks are holding MTMs, bonds till maturity, BTMs as they're called, or mark to maturity, that they're bonds, but because interest rates have gone up, the bond values have gone down. But they're still held at 100% of book value, of the value on the books. If they have to sell them, they can't get that. If they hold them till maturity, they'll get all their money back. Granted, if the company or the Fed does not go bankrupt. But if they have to sell them, then they have to take a loss at market. And as the depositors come and pull their money out of some of these banks, they have to sell these bonds. And as these bonds are sold, they have to take losses. Consequently, if they take losses, that hurts their balance sheet, and that has more people pulling money more out of these banks. So that is the problem because the Fed raised interest rates so fast over the last year. So now the Fed has got to decide, are they good enough? What they've done already, is that going to slow down the economy enough that is going to control inflation without breaking the banks? That's really what they have to figure out. But are they going to do that tomorrow? I think they still do 25 basis points. And at the conference tomorrow, Mr. Powell is going to say, look, we've done enough. We're going to see what happens. We're concerned about the banking system, and the Treasury stands ready. And that's what the Treasury has done, is basically monetized all the banks. That look, if you have money at any bank that's going bankrupt, we'll make it good. Doesn't matter if you've got 250, 500,000, or a million, or 2 million, or 5 million, or 10 million. It's all good. Basically, that's taken away all the risk, and that is where I think the market is going to start rallying from here, especially if the Fed hints that closer to the end of their interest rate increases. As I've said for the last year, as soon as the Fed hits the pause button, the market goes off. We've shaken out all the panic-nistas, as I call them, people who were nervous with the market. They sold out in October. The market rallied through January. They bought the January high at 4,200. Market came back down. Now they're all out. Market will go back up. They'll buy the highs again. Those are people that always snatch defeat from the jaws of victory. They're always running scared. And that's why, because they have too much risk or not enough risk, they don't have the right balance, and they end up losing, somehow snatching defeat from the jaws of victory. You have to have a steady, balanced portfolio. We rallied up. You heard me in January. I said, look, we hit a fifth wave top. You're going to get a pullback. You know what the target I gave you, 3940. If it breaks the 940, we can get to 3800. We hit 3808 as the low, and we're back up above 4,000 now. That's the way I'm looking at the market. Again, the length of bear markets usually about averages just a little bit over 300 days. We are reaching an average of this bear market. We are 220 in 98 days. Market performance versus historical averages. You can see that this is what happens. S&P Performance Index. And I think, we are getting closer to this area. And then from there, we start looking at this as the economy. Looking at the economy, the wage growth is decelerating finally. We're seeing Housing starts, yes, we did get housing sales up for the first time in 13 months. That was just a 1 month number. I think housing is still slowing. They'll continue to slow as rates remain at this level. As the buyers and the sellers adjust their prices, the sellers have got to bring down their prices. The buyers have got to come up and be able to make those down payments and those higher monthly payments, higher mortgage payments, because of the higher interest rates that we've seen. So I think this is going to slow down the entire economy. The banking crisis that we've seen, banks are saying, look, we don't want to lend out this money. Let's hold on to the cash in case we have a bank run on us, so we have the cash available to pay our depositors. So with that, I think we are going to see the banking system make it much more difficult to get loans. When that happens, the whole economy shrinks. That's going to slow down the economy also. So I think the Fed has done enough at this point, 25 basis points. Again, tomorrow, maybe another 25 in May. It depends on what the data looks like. If they see inflation continue to come down, if they see unemployment starting to go up, if they see all the housing prices and rents coming down, I think they're going to stay where they are, and we're close to the peak. Once, as I've said, that is going to be the sign, all clear for the market. Employment growth strong often before recession. That's what happens if you look at employment. It is the last thing that starts to come down during recessions, and that is companies don't like to lay off people. That's really the nature of what they try to do everything else, cut spending, cut costs before they start laying off people. That is the last thing that starts to go down. Or the recession might already be here before unemployment starts to go up. Don't forget to tune in to the daily edition of Market Wrap. You can go to the App Store and type in this entire word, Market Wrap, with Mo and Ansari, and you will get the free app. You'll get the daily edition of Market Wrap downloaded directly to your iPhone. Looking at the technicals, interesting technicals. We went down here. This was the beginning of February. This is the 200-day moving average, this line right here, for the yield on the 10-year note. It came and touched it. I said, we can get a rally from here. We did. We left an island top. That's usually the sign of a turnaround to the downside. We did. That was a top in the yield at 4.1. Then we came all the way down back again to the 200-day. Today we gapped up. I think we hit this low of 3.4. We overdid this to the downside. Now as the Fed raises rates, we could have this go up. As the banking, everybody was buying bonds. When you buy bonds, the yield goes down for safety. I think as this fear abates of the banks going bankrupt, I think that will cause the rates to slightly go back up. Looking at the S&P, interesting chart today. We gapped up today right here. There's a tiny opening between yesterday's high and today's low, and that is a gap up in the market. Now, if we can get above 4,012, which is, I think, a critical number. If we get above 4,012, I think it clears us back towards 4,100 or 4,200, which was the gap here. If we can fill this gap, 4,200 to 4,218, we are gone. The market is on its way higher at that point in time. But we're looking at 4,195 first. We're looking at 4,100 first, then 4,195 or 4,200, and then 4,218 is the takeoff point for the market. I think this is a breakaway gap. You've heard me talk about breakaway gaps where the market opens above the previous day's high and the low is higher than the previous day's low, and there's a gap on the charts. That gap usually signifies a breakaway, or it could be an exhaustion gap. I think this is a breakaway gap, shows the initiation of the next move to the upside. As I've said, I expect April to be a good month. First couple of weeks of March are usually weak. We, I think, got a little bit extra because of the banking crisis, but I think we're headed higher from here. Weekly charts, again, 4,200 is the big number. A move above 4,200, 4,206, that to me will give me a long-term buy signal on the market and probably hit us much, much higher over the next year and a half. Here's the projection. Everything moves in 5 waves. Get wave 1, wave 2, wave 3, wave 4, and now we're getting ready for wave 5 on the S&P. This is, we gapped up again between yesterday's low and today's low and yesterday's high. We see this tiny gap on the charts. That is a gap, and that gap is, I think, a breakaway gap. Next resistance is right around here, which is around 12,000. 12,269 was the previous high there. And this is the projected high. Now, the Fibonacci projection, 12,590 to 12,725. That is the projection, Fibonacci projection to the market. We're at 11.8. So that's another 1,000 points higher than where the market is today. Looking back at the S&P for a second, when we saw this fifth wave top in February, I said, look, we've completed 5 waves. Now we're going to get a down move to the downside. We did. I said, look, if it breaks below 39.40, that was the 200-day, 39.40, the 200-day, then we could go back all the way down to 3,800. Well, we hit 38.08 as the low. That's what I said at the beginning of February, when I said we we're going to start a downside correction. Here at the end of March, we saw a test of 38.08. It was only intraday, one day, and the market is back up today to 4,000. So we're back up 200 points off the lows on the S&P on the upside. Same thing now that we've seen breakaway gaps. I think we are going to start accelerating to the upside. We washed out all the nervous nillies out of the market, and I think we're starting the next leg to the upside. 11,525 is the 200-week moving average. We are above that now, 11,860 on the close. That is a good sign. Gold market hit, as I said, this 1975 was the previous high. We got above 2,000 yesterday. 2014 was the high, but then we got profit taking. We're back to 1943 as of the close today. I think 1887, 1900. Gold, I think, is going to bounce around here. We had the fear, banks going bankrupt, everybody running towards gold, but usually those are temporary dislocations that, oh my God, the world is ending it, and when they realize that it did not end, then people to get out of gold. I think this was the low that we saw, just like I mentioned in October, we made a low. I thought that was the low in the market. Last week when we hit 3,800, everybody was still very worried about banks, Credit Suisse going bankrupt, SVB, all of these banks, and everybody running around. I said, that could be the low right there, and it has been so far. And I think from here, we accelerate to the upside. Depends on what the Fed says tomorrow. If they're raised by 50 basis points, would be a big surprise. Market moves sharply lower. 25 basis points and a dovish comment, I think the market goes higher from here. Those are my views. Don't forget, I'm doing a seminar. I will be in Scottsdale on the 4th. If you want to come to the seminar, it's free. Register right now. Go to compak.com and register. And the 16th of May, I will do a live webinar. On the week ahead, again, I think all will depend on tomorrow what the Fed does. Those are my thoughts. Those are my views as of March 23rd today, or not March 21st today. Again, if you need help with your portfolios, feel free to call us at Compak. Go to compak.com and make an appointment, compak.com, or give us a call, and we will be more than happy to help. Have a wonderful week. I'm Mo Ansari. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.